Good afternoon and welcome back to the Money, Metals, and Mining Virtual Expo. First off, I want to thank our speakers, sponsors, media partners, and most importantly, our viewers for joining us throughout the show and till now. Now for a quick reminder, for the best experience, make sure you're freeing up your computer resources by closing any program you're not using. For troubleshooting issues, please refer to the frequently asked questions by clicking on the question mark at the top of the virtual platform. Now, in his fifth decade in the financial and investment world, I am excited to introduce our speaker, Chris Semple, who is known as an original and proactive thinker whose accuracy on the market over time has been uncanny. He is now privileged to pass on his knowledge to his members at the National Investor, as well as to a broad audience throughout the investment media. Now, to those of you watching live, please type any questions you may have for Chris in the live chat box. Time permitting, we will be happy to answer some of your questions at the end of the session. With that being said, Chris, thank you so much for joining us today. The floor is all yours.
Well, thank you, Aya, and my thanks also to Kim and Chantal and everyone at the Money Show and Brian and his crew at the New Orleans Investment Conference for putting this on. It's always fun to get together and share information. And as you see in our logo here, to share some knowledge available to you on this platform for the conference is actually a long printed newsletter by this same title, as you see on the screen. This is Not Your Father's Gold Market. And what I want to talk about in a few minutes here today, and hopefully saves plenty of time for some questions at the end, is the very big differences between the markets today and how gold behaves, or in some cases doesn't, according to some expectations, going back, comparing that with what we had in the old heyday, when gold first took off from the launching pad just over half a century ago, after the Nixon administration unmoored it from a long fixed price at $35 an ounce. And, as we go through this exercise, I always like to be provocative. I always like to be challenging and get people to understand that some of the things that we believe maybe not, aren't always true. You see this quote from Mark Twain on here, and regrettably, a lot of times in the precious metal space, there's a lot of things that people have in the back of their mind, preconceived notions and things like that, that don't really reflect where we are here in the year, closing the year 2022. Now, we're going to go through quickly first some of the major interludes that gold has had, some epics, if you will, in this 50-year move, where frankly, if you go back all the way to 1971, when the modern market era, not always clean and seamless to be sure, of gold started, we've gone from $35 an ounce to close to $2,000 an ounce, actually a little over $2,000 an ounce on a couple occasions. But to this day, the biggest move in percentage terms and in all of the traditional ways in which we would expect to see gold move did happen in the 1970s. Richard Nixon, as we all know from history, broke that link between the U.S. dollar and gold. Back in those days, the U.S. dollar was uniquely being debauched. The rest of the world hadn't caught on yet. In Germany and Japan and France and the UK, the other major developed nations. So we were by far the worst in the world at inflating the currency, devaluing the dollar. And as you see here, we had a 2,300% move bottom to top during just shy of a decade where the gold price was concerned. And a lot of people at the end of that decade of the 1970s, and as we went into 1980, and a very brief peak for the gold price at over $800 an ounce, with a lot of things that were in play at that time, people thought we were going to continue to see this exponential increase in the gold price. But lo and behold, we did not. For 20 years after that big manic peak in 1980, gold, after a big drop back down, kind of meandered, and it worked its way lethargically sideways to slightly down until we reached the bottom, and actually a double bottom in 1999 and then in 2001 And what was interesting about this, and I'm going to get into the details of this in just a second, this did not happen because governments were not running deficits anymore, ours or anybody else's. Didn't happen because the monetary base was not going up. In fact, we had an exponential increase during the 1980s and 90s in money, in debt, in the monetary base, and otherwise, because I'm going to explain to you in a minute, and the most important thing you're going to take away from this, that you really need to have under your belt to understand not only gold and silver, but markets and our economy generally. Paul Volcker in 1982 changed forever the way in which the Fed engineers the economy by first engineering markets. He turned things upside down. Inflation accelerated dramatically in the 1980s and the 1990s. The problem was, and I'll explain this in a minute, everybody looked for it in the wrong place. Through a variety of means, the inflation that continued and accelerated from the 70s and into the 80s and 90s, and of course to this day, was diverted. Didn't go into for a long time until just the recent past, the prices of goods and services and whatnot, but it went into financial assets and so forth. So as a result, gold became a wallflower, very much so during this time. There was even a stretch, mostly in the 1990s for a period, where gold's price was managed to a great extent by a very tiny handful of players. To this day, I have in my possession an article from the Financial Times, 3 full pages they devoted to this. And some of you old timers in the gold space will remember this. Barrick Gold, or that in those days called American Barrick, was a company that gold bugs loved to hate, because how is it that Barrick Gold is making money when everybody else is just yawning and, you know, if they're lucky as a producer, breaking even with the gold price, you know, going down to the 300s and then every now and then into the upper 200s an ounce? How did that happen? Well, it was almost like Barrick knew what the price was going to be. Well, guess what it was? There was a several year period of time where the gold price was managed by Barrick and a few other players, just like the Beers cartel managed diamond prices for so many years. And the Financial Times once upon a time had a really cool story about this, exposing that and how former Prime Minister Mulroney of Canada, George Bush Sr., Republic Bank of New York, and a couple other players were involved in this kind of thing. So after that big move, we had a 20-year period of time where gold was kind of in the wilderness. But then we had a double bottom, again in 1999 and then in 2000. Then we had another period where we had a very sharp move higher in the gold price. And it actually came about in 2 stages and for 2 very different reasons. And on the screen here, you see where once the gold price bottomed in that 260-ish or so an ounce area, it started to move higher. And those of you who remember know that Alan Greenspan, who was chairman of the Fed back in those days, first engineered, and the only single verifiable time, and remember this, verifiable time, that the Federal Reserve was actually involved in gold price suppression. And that was in September of 1999, when everybody in the market that was offside was surprised by the central bank gold agreement back then. I go into details on this in my written version of this and a couple articles on my website, so you're going to have to look at that later on. But the same Alan Greenspan, who in 1999, when gold out of nowhere spiked to $340 an ounce and everybody was in trouble and they had to smash it back down to get everybody on side again, that same Alan Greenspan a couple of years later, as gold was going back up to that price and higher, was cheering, because he said, hey, look, I told you I was going to whip deflation. We're not going to be like Japan. And it continued to go higher. And so for that period from about 2001 or so through 2007, the beginning of 2008, gold went up in kind of this environment of a rising tide lifts all boats. Yes, it had some monetary policy help from the Fed, but that was a big boom time, if you remember, for just about everything, including commodities. Back in those days, especially, was when China was having its first major growth boom. It was building the equivalent of the city of Houston once a month in that country back then, and it didn't matter what it was. In fact, gold did great. Gold stocks did great during that time, but so did everything else. Then we had the fall of 2008. Everything crashed. Gold, after tickling $1,000 an ounce, dropped to under 700. But it was the first thing to start recovering, and then it had an even bigger spike higher. And in 3 years' time, it tripled, but for very different reasons. And I'm going to come back to this epic, this period from the end of 2008 to the end of 2011, because this is what is going to be required to have a sustained move high in the gold price again. So at the end of 2011, what happened? We had, again, first we had the love trade and gold stocks, everything did great. And then we had, in 2008 through 2011, really what was the closest thing to a 70s style trade, where we had a lot of money printing. People were afraid that we were finally going to start carrying money around in wheelbarrows again. But lo and behold, what happened? That was the peak for gold in 2011. And in the time since then, even though we've nominally exceeded the 2011 highs a little bit, we've been treading sideways one more time. And again, not because the Fed is printing less money, it's printing way more money, but because a lot of other asset classes were getting the benefit of that money printing. And so gold bugs are off to the side here thinking everything is supposed to always benefit gold all the time, and it doesn't. There's reasons why it didn't happen. And I'm going to explain to you what those reasons were. Now, let's go back to the beginning one more time and approach this from a little bit more of a historical perspective on monetary policy. So there's the dynamic duo, Arthur Burns and Richard Nixon. Burns was one of the predecessors, of course, of the modern day nitwits that are destroying and debauching currencies. You know, he was followed by a few lesser known names. Everybody's long since forgotten about the G. William Millers and the like. But then we had Volcker come along. What changed? Well, I'm going to tell you what changed. Some of you who have been around for a while and have followed these things know that at the end of the 1980s, we had double-digit inflation. We had double-digit interest rates. President Reagan was elected, and he set up what was called the Grace Commission. That was the popular name for it. The official name was the President's Private Sector Survey on Cost Control. And J. Peter Grace was the head of this commission. One of the members was Harry Figge, who was the founder and chairman of Figge International, a Fortune 500 company at that time. Figge took out full-page ads in a Wall Street Journal, Washington Post, Washington Times, New York Times, spent a lot of his own money saying that we are bound to end up like these banana republics in those days were down in Central and South America, triple-digit inflation, quadruple-digit inflation. And this thing on the screen here is one of many things he put out. I handed out zillions of these pamphlets, it seems, myself back in those days. And he was saying that you get to a point where all of a sudden, after going up methodically, just the dynamics and math of a fractional reserve system, you get that upright spike afterward where things just uncontrollably move higher. And he was saying that we were doomed if we didn't change this. Well, what changed? Did Washington stop deficit spending? No. It was scandalous when under Jimmy Carter, the deficit was $40 billion a year. By the time Reagan left office, it was moving in on $300 billion a year. But again, as I'm going to explain to you, Paul Volcker in his second act, when he was reappointed by President Reagan, changed things. And this is something to this day that a lot of gold bugs don't even understand. They're all fighting the last war of the 1970s. We're not in that world. We haven't been since then. Now, if I had told you, back in those days when Figge was saying what he was and that kind of thing, that look, say I'm talking to you, Sam, I think all of these gold bugs are nuts. They're wrong. We're not doomed. We're not going to see triple digit inflation, at least here in the US. We're not going to be carrying our money in wheelbarrows. In fact, I'll tell you what, right now, the national debt is what? $1 trillion? It's going to hit 30 trillion in the next 40 years and then some. And that's what the government tells us about. But yet civilization will still be here. We'll still have what looks like on the surface a thriving economy. The stock market will multiply 30 times. and interest rates won't be what they are today. Now, if I'd have told you all that and said that this is what was going to happen in 40 years, you just called Happy Acres and had them send a rubber truck for me. But that's what happened. How and why did it happen? And this is what's so comical today about these things where Jerome Powell is going to be tough now like Paul Volcker. Okay, well, he's being a little bit tough like Paul Volcker in the recent past after first being an arsonist and now pretending he's a fireman. But let's go back to the real Paul Volcker. What did this guy do? All right. There's something called the wealth effect, a term that was coined back about, the latter part when everybody caught on to what was going on of Volcker's term as Fed chairman. And what happened was the Fed figured out that as an original matter, it just flooded the markets with money. And that money from the top down fostered economic growth, caused corporate earnings, and caused people to get higher wages and all this kind of stuff. We can reverse the process that the economy and markets always had, because up until that time, the economy was the economy. People had innovations, they had businesses, they went out and worked for a living, and the markets were a reflection of how well the economy was doing. And now since then, and we've all seen this in spades in the recent past as this thing has gotten really out of hand, now it's the Fed that first has to print tons of money, quantitative easing, lower interest rates to nothing for a long time, goose everything, to have any kind of traction in the economy at all. That's what this guy did. So we have the wealth effect. And of course, Harry Figge was right that we were going to get these spikes higher as the Fed accelerated. I mean, we're at a point today where the annual deficits for on and off for the last several years have been higher than the total national debt was when Volcker was in there. But those spikes went into the stock market. Of course, we had the great stock boom that started in 1982 with the Dow Jones under 1,000. We've had a serial inflation of asset prices. And look, at the same time, it's no secret for those who have studied this why a lot of the inflation never did end up in finished goods and services and things like that. Why do you think at the same time there was this big push to move manufacturing out of the US and into other countries where labor was a lot cheaper? So that as the Fed printed all this money, it didn't go into the things that alarmed people in the 70s and caused them to buy gold, but instead it went into the stock market and said, oh, goody, our stocks are going up. That's a great inflation hedge by itself. We don't need gold and all that kind of thing. But as time has gone on, as I said a minute ago, the thing has gotten dopier and more risky as things have gone along. Alan Greenspan gave us unregulated derivatives that, among other things, caused that crash in 2008. We've had these boom and bust cycles. And so gold, again, with one notable exception of 2008 through 2011, has been a follower and also ran during this time. And there's something else that we need to remember too. I was talking to my wife the other day. We were at St. Patrick's Cathedral in New York City several days ago, actually it was last Friday, and commenting about the majesty and how things used to be. And now you have people come into that cathedral, let alone others, and they're wearing jeans that it looks like nobody sells mothballs anymore. The jeans have all got holes and cuts and tears in them and that kind of thing. Times have changed. The culture has changed. A lot of people who understood years ago that gold is a viable hedge, they're gone, they're dead. And, the 1% or so, give or take, of people who understand why they should be in gold, they're already fully invested. What we're going to have to start asking ourselves now is what will motivate today's investors? Because it doesn't matter how much all of us in our gold bug echo chamber object to the idiocy that we see and how much we object to today, gold-related equities being so ridiculously cheap, worse than anything any of us have ever seen in our careers. What's going to turn these people on? What's going to turn on the generalist investors? What's going to get the experts coming on CNBC and Fox Business and in the Wall Street Journal and et cetera, saying that, hey, we got this problem. We better start looking at gold as a hedge again. I don't think it's necessarily going to be the 70s version. A lot of people still like to carp about, well, the dollar is going down in the toilet. In case you missed it, the dollar has had one of its greatest runs in a long time this year. It's given some of it back recently, may not have peaked for sure yet. I wouldn't be betting on that. Yes, gold has had somewhat of an inverse correlation to the US dollar again, but that's a 70s argument. We're past that. Nobody's currency is backed by anything substantive right now. I think the more likely thing is that we're on the edge, which is why for the first time in a while, I've turned sector bullish on precious metals again. We're on the edge of one of those 2008 type of environments where the economy is going to meander downward. It's not dead in the water yet. Most other economies are far worse than the US, but we're going to see a recession unfold inevitably as we get into the next year. The Fed at some point will have to realize that it's going to have to at least suspend its rate hikes. So back then, if you remember in 2008, I'm going to go back up a slide first. In 2008, what animated people back then was that the economy was so badly broken after the financial crisis. Everything had dropped. The real estate was a mess. Everything was a mess. And yet the Fed had to start printing all this money, try and save us. And it didn't have a lot of traction in helping the markets or the economy right away. And so disproportionately, gold benefited from that surge in money printing when Ben Bernanke instituted quantitative easing, when a lot of other asset classes didn't. And frankly, the reason why I was telling people during 2011 to sell our gold stocks, a lot of them, and our trading positions entirely during that year, was when that money printing finally did start having some traction in pushing the stock market and real estate and the rest of the things higher again. I think we're going to be seeing that kind of scenario unfold as we get into next year. The Fed will be forced to pause, if not start to reverse its recent easing, but it's not going to help the economy. The economy is choking on so much debt, so many problems in the world that is, I think, going to disproportionately benefit gold. Let's move on. Where is the weak link right now? Why are we not seeing with 40-year high inflation this year, why aren't we seeing some of these predictions of higher gold prices come about? And yes, I realize that gold has done decently in 2022, better than the stock market generally, even if gold stocks haven't done it. Well, you can't blame central banks, because central banks have been building up their gold reserves again. In fact, some of you already have seen, I'm sure, that in the third quarter of this year, there was record demand for central banks. So this idea that today there's some conspiracy or shadowy cartel that's trying to keep the gold price suppressed as far as central banks are concerned, is quite a lot of them, I guess, didn't get the memo. One thing is going to jump out at you from here, and it's something I said just a minute ago. What is the investment case for gold? Because that is what is going to get those people who in 2008 through 2011 weren't gold bugs, but they realized that something changed and something compelled them to get into this sector, because the conspicuously weak part of the gold demand area, and in fact, apart from central bank demand, it's the one that I think is going to be the biggest one going forward, because jewelry will weaken again if we see the global economy weak. Now, a lot of investors still aren't figuring this out yet. They're all waiting for the Fed to pivot or to run up the white flag or whatever you want to say, not because they think that gold's going to go up, because they want the stock market to recover. We've probably seen a multi-year top for the stock market already, and the only question is how far down we go. A lot of investors listen to this guy, the Bobcat Goldthwait of CNBC. He doesn't see a recession coming. We're going to have a rolling recession. Not going to be terrible. At least early on, it won't be as bad as some other countries, but things are not going to be going in a positive direction as far as growth is concerned. What I think is going to animate people and get them back in the gold space is a presentation I've given a few times now this year, which you can find on my page at The Money Show, on a new FANGs. The G at the end, of course, stands for gold and other metals. And I think, folks, for the first time in a long time, the broader prognostications that we're going to have a secular bull market for a lot of commodities to the detriment of financial assets is going to be true from this point forward. So gold will still have some competition, but it's not going to be against tech stocks and meme stocks and cryptocurrencies. It's going to be against maybe some better performing ones like this year, uranium, natural gas, crude oil, etc. The two great facts of life that I've talked about on a few of my other Money Show presentations this year, the great stagflation. We are not going back, barring the Fed throwing us into a full-blown depression. We are not going back to 2% inflation. We're going to stay chronically high for a long time to come. And our move to a multipolar world with everything that comes with that, that is all going to be undergirding the case for gold going forward. And a fun thing for you, if you're an investor, as I close, I've always said that from time to time in the past, when the generalist investors move into the gold space again, it's like a 300-pound man jumping into a small kitty-sized wading pool. For some of these things, it's going to be like an elephant jumping into a kitty-sized wading pool. So with that, let me remind you that you can get the full version of This Is Not Your Father's Gold Market here through the page or by contacting me. And Aya, for the few minutes we have left, I'd be happy to take questions.
All right. The first one is from Ross. He's asking if you're still an Ecuador fan.
I'm very much an Ecuador fan. I don't have as many individual company exposures as I did for a variety of reasons, but it's still an up and coming jurisdiction. I have seen through more than one example of gold and copper projects primarily getting permitted that they have moved way faster than what you're going to typically see in the US and Canada. It's a young country. It's still got its challenges, but it's got a president who is pro-markets. He's a capitalist. I don't always agree with everything that he does, but by and large, it's a country that sees its future very much tied to a growing mining industry. So you've got to be careful. You've got to pick your spots. There's parts of the country that you don't want to be involved in. But again, that's no different than here in the US. You know, look at the Pebble project in Alaska that none of us will ever live to see developed. But that doesn't mean Nevada's no good. So generally speaking, yes, I like Ecuador.
The next question that I have is from Joseph. He's asking, what are your views of crypto versus commodities?
I think that they're two different things. You know, I was on a friend's panel recently. There was 3 of us on Team Gold, and we had 3 people quote against us that were hawking Bitcoin and cryptocurrencies generally. I don't put them in the same category. A lot of gold bugs have made the excuse that gold would have done better were it not for Bitcoin and other cryptocurrencies. I don't agree, because most people buy gold because it's going to be a long-term inflation hedge, it's a crisis hedge, whatnot, and almost to a person, anybody I've ever talked to about cryptocurrencies doesn't buy them for any of those reasons. It's because everybody, the cab driver, the dog groomer, is getting filthy rich on these things, and you'd better do it too. So, you know, what Bitcoin and cryptocurrencies futures are is a story for another day, but I don't even put them in the same category. Commodities generally, go back and look at my new FANGs presentations. They are their own story.
The next question that I have is from Rashmi. He's asking, what price do you expect gold to reach in 2023 and onwards?
I won't even try and put a number on it, but I will say this, and I always have this kind of an answer when someone asks me, you know, what do you think the top's going to be for stocks, or the bottom for stocks, the top for gold in this case, whatever. I think that as I explained, the circumstances are bringing us back to this type of environment we had in 2008, 9, and 10, where we're going to see weaker growth. The Fed is going to be forced to start supporting things again. It's not going to have traction in the economy. Will gold triple as it did back then? I have no idea. But what I will be telling our subscribers is when I see those factors and characteristics, if I'm correct, accelerating, will add to the renewed sector positions in gold and silver. So far, just the leveraged ETFs on the metals themselves, not the stocks yet, at least in a general sense. I've got individual stocks recommended, but not the ETFs. We'll start adding the ETFs as things evolve, and we'll probably, you know, increase our positions overall to precious metals. But, are we going to go to 2,500 next year, 5,000? I have no idea. It's going to depend on a lot of things. But, for the foreseeable future, by and large, I do think we've bottomed and that the direction is going to be upward.
Awesome. Well, that is all the questions that I have. So if you want to let the audience know where they can find you and follow you for more advice coming up, please feel free to share that information before we end.
Yep. Nationalinvestor.com is my website, or email me at chris@nationalinvestor.com. If you'd like these slides, for example, I'll send them to you, and make sure that you do get the full version of This Is Not Your Father's Gold Market here on the Money Show's resources. A lot more stuff in there that I didn't have time for.
Awesome. Well, with that being said, Chris, thank you so much. And I want to wish both you and our audience a happy holiday and a happy new year. And I hope next year is better for everyone.
Thank you, Aya. Take care and all.